Good afternoon, everyone. Welcome. I'm Scott Hodge, President of the Tax Foundation. I'd like to thank all of you for joining us this afternoon for another of our Tax Foundation Talking Tax Reform events. And we're coming to you this afternoon from all parts of the Washington, D.C. area. As many of you are no doubt regular attendees at our lunchtime events on Capitol Hill and are used to having that wonderful Senate pizza. Well, I'm sorry, there's no pizza today. And but I'm told that Uber Eats will deliver it to you in 30 minutes or less. So lunch is unfortunately not on the Tax Foundation today, but we do have a great program. Today's topic is economic recovery after the coronavirus. And as we all know, for the past few months, Washington's focus has been solely on the short term and providing immediate relief for families and individuals, and of course, trying to provide liquidity for businesses who have been most affected by the shutdown for coronavirus. And now as more and more states begin to relax their restrictions, it's time to start thinking long-term about pro-growth and sustainable tax policies to help the economy recover and to have strong economic growth. But this raises a number of questions for our speakers today. What are the challenges that we expect to face as the U.S. economy begins to reopen? What are the best tax policies to encourage a smooth transition and strong economic recovery? How should the goals of economic recovery and growth be balanced with revenue needs? You know, after all, the various relief packages added over $3 trillion to the deficit. How important is the deficit in this context? The CARES Act had to reverse some of the tax changes that were in the Tax Cuts and Jobs Act, like changing the way in which net operating losses or NOLs were treated. So how can policymakers improve the U.S. tax system so that it's better prepared to deal with these kinds of issues and crises in the future? Well, for answers to these and many other questions, we have an excellent panel of some of today's leading tax and economic experts. You'll hear from Garrett Watson, Senior Policy Analyst at the Tax Foundation. You'll hear from our friend Ben Ritz, who's Director for the Center for Funding America's Future at the Progressive Policy Institute. And you'll hear from Carl Smith, Vice President of Federal Tax and Economic Policy at the Tax Foundation. But before we get to our all-star panel, we have a special guest to kick off our discussion, Congressman Jodey Arrington. Congressman Arrington represents the 19th district in Texas, which I think includes Abilene and Lubbock out there to the west of Fort Worth. And believe it or not, he is only the 5th member to serve in that district since 1935. So there's a lot of longevity in that district. Congressman Arrington is, of course, on Ways and Means Committee, as many people know, and has been spending a lot of time recently looking at what kinds of tax policies will be most beneficial to get the economy back on track. Well, Congressman, welcome. Thank you for kicking off our program this afternoon. How should we be thinking about tax policy and the COVID recovery? The floor is yours.
Scott, thank you. And I'm glad that the bar for my performance today is just to exceed cold pizza at the Capitol Hill Club or the cafeteria, either one. It's an honor to be with you and your members. Your organization has been is a tremendous value to all members, both sides of the aisle. I think you all have the credibility that's enviable here in our nation's capital among these think tanks and outside policy groups. You guys, play it down the middle. You have your core principles and you stick to them and you're true to them. And I think that I think your influence on tax policy is evident and was evident as we debated the Tax Cuts and Jobs Act and as we mull over ideas for the short-term recovery tax proposals that would benefit our country's rebound. And as we look to the long term and what we would do, whether it's a negotiated tax proposal or it's tax reform 2.0, if the Republicans were to get the House back, you all do a tremendous job helping us sort of the North Star for us on what proposals make the most sense and will bear the most fruit in terms of growing the economy, providing opportunities for our fellow Americans and the like. I believe fundamentally that in freedom, and I think it's not just free people and free states, but free markets. And the most powerful force, save and except the love of God, is freedom, to unleash the human spirit. And I think that's what America represents to the world. And I think the free enterprise system has proven that when you unleash that human spirit in the marketplace, we've created the greatest technologies and innovations. We've produced the most jobs and the largest middle class. And we've contributed to more people and their quality of life, not just in our country, but around the world. So I want to keep it that way. And I think we've made our tax code more competitive. We've made it a fairer code, a more competitive code. And we have seen at least pre-COVID, we saw probably the quickest return on the investment of more freedom in the marketplace. I think you can say that adding the free market pro-growth tax policies with what the administration has done on the regulatory side and relieving the unnecessary burden on our job creators provided unprecedented growth. And your members know the statistics, but I think it bears just reflecting a little bit on the historic low unemployment, the jobs that were coming back to this country, the fact that we had more jobs than we had people to fill them is exactly the problem we want to have, again, in the near future. And so fortunately, we had strong fundamentals and we were in a strong economic position before COVID. I don't think every country can say that. And it's going to help us recover. And we have to make decisions now, what we need to do from a temporary targeted basis on policies, tax and otherwise, and what we need to do to seize this as an opportunity to make our country even more competitive. You know, we were talking the other day, just from a healthcare standpoint, there have been barriers to innovation in healthcare, government barriers, whether it's regulatory or reimbursement policies, to allowing technology to solve not only access, but reducing cost and improving the quality of care. It's one of the few things that I know of that can, that is a triple threat. And telemedicine, telehealth has been talked about for years, if not decades. I ran a telehealth company before coming to Congress. And I can tell you that many of the problems that we face in healthcare, which is one of the toughest nuts to crack from a public policy standpoint, many of the solutions there are already available, and they are technology related. So we need to codify, for example, some of those policies that we changed and regulations we relaxed with respect to allowing technology to solve those problems. And we need to make those permanent. We need to learn from this, and we need to seize that opportunity for the sake of our country and the people we serve. But I do want to say again, thanks for your friendship and your partnership. You've helped us as we have tried to be part of that framework for long-term, not just long-term recovery, but prosperity, thinking about how we can take this competitive tax code to the next level. Obviously, y'all are very familiar with the tax reform 2.0, but I think there will be an opportunity to either have a bipartisan set of proposals, and framework, which I think is always a more sustainable path, or if we are in the majority where we would go with round 2 or tax reform 2.0 to do things like make the business expensing, full expensing, a permanent fixture in our tax policy, and not one that will expire. I think providing that certainty and the ability for these companies to plan these big capital expenditures in ways that will promote growth, as you all have said, and as Grover Norquist and as Heritage and others, that is the most pro-growth tax policy we can advance. And we introduced the Align Act that would make full expensing permanent. I know my colleague Ron Estes has introduced full expensing made permanent, not where it would be amortized on the R&D side. And I think that's critical. Before I was trying to launch a telehealth company, I was the vice chancellor for R&D and technology commercialization at Texas Tech University System. I represent Texas Tech. They're the largest employer in the region. We do about $200 million annually in R&D. And then I managed the IP, and we would start companies, and we would license our technologies to other larger companies. And it was just an awesome sort of experience to see the innovation ecosystem at work, and what are the inhibitors to that, and what are the accelerators to that. I think there's some opportunities there around startups, but we have to maintain our competitiveness, and it's not just on the investment in capital expenditures. It's not just the making permanent the 20% deduction and making sure we have parity among small businesses, which are driving the job creation in this country, but making sure that China doesn't eclipse us as they are already making more per GDP investment in R&D. So we've got an opportunity there on the R&D side with respect to tax policy. I don't want to wear you out with a bunch of rambly speechification here. Scott, again, we appreciate your leadership. We appreciate your organization's value-added counsel to me and my colleagues. And I'm looking forward to working in partnership with you as we advance the Align Act and as we look to tax reform 2.0, and we do things that I came up here to do, and that's serve our nation and make sure that my children and your children and grandchildren have a land of opportunity to look forward to. I'll end with this. The only way our kids inherit a land of opportunity and a land of freedom is for us not to be enslaved by massive, mountainous debt. Our debt to GDP now being soon to be, I guess, the most debt load carried per the size of the economy in the history of our nation, exceeding now the World War II at 104% GDP at the time. That is scary, and that should scare everyone. And no one, not the smartest of experts on this subject and economists, and I've heard from many of them as a budget committee member, as the super committee member on appropriation and budget process reform, which happened in one of the biennial budgets in last session. I was the only freshman on that committee, learned a lot, but no one knows exactly when that thing begins to tip and the dominoes begin to fall, but you can't put it back when they do. Some folks say, this body politic cannot govern our fiscal affairs in a way that we can rein it back. It's just not in our nature. States have a balanced budget amendment, essentially, that forces them to operate in a fiscally responsible way. We don't, and that's a mistake. But I do think, Scott, that we don't have to wait for the next big crisis, which would be a sovereign debt crisis, which we can't spend and print money to and borrow to bail ourselves out of. That's one you can't do. You can do that in this one, and we are doing it, and it's appropriate we're spending money at this point. But we can seize this crisis as an opportunity to do some things and put provisions in place that will force Congress to deal with that issue so that we can stave off the ultimate crisis, in my opinion. And I do think it is the ultimate crisis that would reduce our nation to less than exceptional, and it would affect everything in our society, from defense to agriculture to infrastructure, you name it. Life would change as we know it, and the opportunities and the economic conditions for our children are probably indescribable relative to what every other American has experienced. It is the 21st century challenge for our nation. And I am proud to say that I'm leading a group of bipartisan members, 30 Republicans and 30 Democrats, who are taking this head on and looking for a way to insert reforms that can be triggered after we recover in a way that force Congress to do what is not in our nature and actually go after this. And I'm doing that with Scott Peters. I'd love to expand on that in the Q&A session, but I think I'll just stop there and open it up for your guidance and the questions from your members. And I'm just grateful to be with you.
Well, thank you very much. No, that's really interesting. I do want to get back to, and let's pick up on the deficit and debt issue. As I mentioned in the introduction, the recovery proposal or plans altogether have added about $3 trillion or more to the deficit, and so we're stuck with this balance or this trade-off or dilemma. Do we enact policies to try to help economic growth more moving forward? And then how do we deal with this mountain of debt that's added? But I mean, obviously, I think most people would agree that these policies to shore up the economy were needed, but now we have to pay for them at some point. How do we balance that out? How do we think about that? And perhaps some of the proposals you're talking about may address that as well.
Well, I hope they do, Scott. And what I'm as far right ideologically as you can be in terms of philosophical view of the role of government and the life of our country and the lives of our countrymen. And I don't make any apologies. That's what I believe is best for a safer, stronger, freer America. But I respect all of my fellow colleagues and members of Congress, and I always work with them in a way that assumes that their intentions are a safer, stronger, more prosperous America as well. They have a different view on how to achieve that, and I will fight tooth and nail and will battle with every cell in my body against what I think are big government centralized planning and sort of European style socialist policies. But at the end of the day, I'm not king, and I'm not so arrogant as to think I have all the answers either. Both would suggest that I'm going to need to work with Democrats on solving some of the biggest problems, because the biggest problems that we face will generally only be solved when we can come together and work in a bipartisan fashion. In this case, with respect to the debt, I think we have a spending problem, not a revenue problem. Obviously, seeing the revenues go up when we created a more competitive tax code, we brought not just more jobs online, but we increased our tax revenues as a result, 4% to be, I think, exact. But I think that the issue here is the process, and I'm not a big process guy, but what I've learned, and especially in that super committee and being on the budget committee, is that I don't think either side has had the will to truly deal with this. And I don't think this is, the Democrats' fault. I think it's the fault of this institution and the dysfunctions in our processes. So if we can reform some of the policy neutral processes to force us to make what will be some compromised decisions to deal with the debt to GDP, I think we have a chance. We had about 50, so this group that I brought together, no label to it, no, it's not a caucus, we're just a group of concerned members, and Scott Peters has done a great job bringing folks from all of his caucuses, and I brought the chairman of the RSC, the chairman of the problem solver co-chair, Tom Reed. It's very diverse and it runs the spectrum ideologically. And what we've done is teed up several reforms and on transparency, responsibility, and accountability. For example, we voted and came up with 3. Now we could have done 5, we could have done 10 probably. And but we wanted to write a letter to, and this is hot off the press because we haven't sent the letter, but we're sending a letter to Nancy Pelosi and Kevin McCarthy, and we're imploring them to include bipartisan proposals to force Congress to deal with this issue of the rising debt. Our 3 that we chose, at least in this round, and there's more to come, was a State of the Fiscal Union, which is essentially a cultural change to always put this issue at the fore of our deliberations and raise it in the consciousness of Americans who are too used to seeing the trillions of dollars in debt that we're carrying. That's a deferred tax on our children, but we're gonna create this annual State of the Union, but on the fiscal condition, and that's one of the provisions. The other is debt to GDP targets on a glide slope that would walk our country's fiscal position to a more, our debt position to a more responsible, sort of an average over the last 50 years. And that's something that takes time, but we can agree on the debt to GDP targets. And that's one of the proposals. And thirdly, we have a trust act, which is essentially a debt commission, kind of Simpson-Bowles-like, taking on the big trust. Mandatory spending, as everybody knows, is driving the debt. And we've got to deal with the mandatory side. The blank check, the auto spend, that's the killer, but also making sure that we provide solvency for these important safety net programs, et cetera. Those are 3, and we're pushing it, and we're going to send that letter out probably Monday, but I think that's quite an achievement. We see that this is an opportunity to advance those and not wait for the, and use this opportunity in this crisis rather than the one that we can't bail ourselves out of, if that makes sense.
Well, sure. We've got just a few minutes, but sadly, I've been around Washington now for far too long, and remember a number of these bipartisan efforts to reduce the deficit, going back to Graham-Rudman and others. And oftentimes, these policies or these large mega proposals end up being a balance between spending and new taxes. And we have heard a lot of talk recently, because of the rising debt, for the need for new kinds of revenues, such as a value-added tax, a carbon tax, higher taxes on the rich, and what have you. And how, again, might you balance these 2 ways of reaching lower debt and deficit levels? Is it a balanced program, or do you lean more heavily on the spending side?
Well, I lean totally on the spending side because we've gone so far beyond the scope of the mission of the federal government as delineated or enumerated rather in the Constitution. That's an easy one for me. But because of what I've seen in the expansiveness of this country, the programs and the spending that come with it. But I'm a realist, okay? And I'm practical enough to understand that because I'm not king and because we have divided government right now, and probably will, even in the Senate, no matter how it shakes out in 2020, you're gonna have to have that 60 vote. We'll always have an opportunity at reconciliation. We had that opportunity when we had the majority, as you remember, Scott. I was on budget. We passed the deepest mandatory spending cuts in 20 years at $200 billion. Well, you could cut spending at $400 billion, and you won't. And that's enough just to sustain our current debt position, not bail out of the deficit spending and the debt. It just won't. You can bail out of the deficit, you cannot bail out of the debt at that level. Right. So neither side has done enough. It will have to be a balanced approach. You gotta leave, I don't want the revenue side of the equation, but it's kind of like what Reagan did with Social Security. It's the way we're gonna have to fix Social Security. I don't wanna raise payroll taxes at all, but you're gonna have to have the benefits and revenue that comes with it, along with the cuts, like raising the age of retirement. You just have to put it all out there and be policy neutral. What we have to do is provide a trigger, an enforcing mechanism that forces us to make a decision now on these things and not wait until it's too late. That would be a far worse problem to deal with. So I'd rather have a little risk by putting all policies on the table and having a balanced approach. Me fighting on the spending side, obviously, but then I would having a sovereign debt crisis, which is far worse for our country.
Well, thank you very much. That's a wonderful topic, and I'd love to come back to this at another program because I think that's a topic that's worth at least an hour or more of our time to go into more depth. And I want to thank you and congratulate you for starting a bipartisan dialogue on this. It's absolutely critical, as you say, and you need to have some measure of collegiality and open dialogue to get that issue done. So congratulations on that. Thank you so much for kicking off our program this afternoon. I appreciate it. I appreciate the work that you're doing, and I'm glad that my team can help in any way possible. So thanks again, and we look forward to working with you in the future.
Scott, you guys are the best. And like I said, your reputation, credibility preceded me, but I hope we can continue to partner up, as we say in Texas, to do some things that to continue to innovate and to continue to make our code competitive and to continue to strengthen our position as we rebound from this COVID crisis and show the world that economic freedom and free markets, as well as free people, are not just the best way to sustain quality of life, but to respond to a greater quality of life, learning our lessons from crises like this. That is the goal. We should lead, and you guys are going to help us. So God bless you guys for what you do, and thanks for your friendship.
Thanks so much.
Great day.
Thank you. That's a great lead into our panel. So thank you again. And now we'll turn it over to our panelists. I think we may have some housekeeping to get to. If Tyler, you can pull that up. Just a few words on, or be able to show people how they might contribute questions, because we do want to encourage questions from the audience. Yes, it is recorded. And I guess that means we're on the record. We'll go on to the next slide so people can see how they can contribute questions. And we already got quite a few in advance. So this looks like to be a lot of interest in getting to our panelists. We'll start off with Garrett Watson. Garrett has been spending a lot of time looking at different ways in which tax policies are affecting small businesses and entrepreneurship in particular. And Garrett, if you could kick us off, the panel, to talk about the ways in which tax policy can help entrepreneurs and help with economic growth in the post-COVID recovery. The floor is yours.
For sure. Thanks, Scott. As everyone knows, the coronavirus crisis has created an unprecedented challenge for policymakers. We have about 40 million workers that have been laid off as of today. And the Congressional Budget Office projects one of the sharpest economic contractions in American history. To put some numbers on that, they're estimating about a negative 37% economic contraction annualized in Q2, and unemployment peaking nearly at 16%, and that's on the optimistic side, according to many estimates. And as we've just heard, many have referred to the possibility of a V-shaped recovery that relies on a strong rebound in the second half of the year. To get there and to supercharge economic growth past the crisis, we're going to need smart public policy and smart tax policy that both bridges businesses and individuals over the short run, while also setting up the American economy for long-term success. While the focus of today's event is on reforms to tax policy that are going to ensure a robust recovery over the long run, it's still important to emphasize that we're still not out of the woods yet to ensure that individuals and businesses do make it out of the crisis from a liquidity perspective. The sheer scale and scope of the collapse in demand over the past 3 months has really put pressure on firms of all sizes, as well as vulnerable individuals. Firms on average, especially small businesses, only have a few weeks of cash on hand on average to cover their various fixed expenses. In the worst case scenario, a wave of insolvent and bankrupt firms, especially small businesses, would be catastrophic for America's ability to get out of this crisis on a reasonable timetable, and it would also destroy workers' links to their old jobs. So it's highly important that policymakers make tax policy changes that both provide liquidity for businesses while also ensuring that vulnerable individuals can make it through the crisis. In March, of course, the CARES Act was passed, which made progress federally on both of these goals. But more may need to be done given the length and depth of the reduced economic activity we expect to see in the coming months. So with that said, while policymakers have many options left to address the crisis, and there are many competing visions on how we should address both the crisis and economic growth moving forward, I want to focus on two important elements that should be addressed in either the phase 4 policymaking over the coming months or in subsequent reforms that can help us get back on the path toward long-run growth, especially as it relates to small businesses and entrepreneurs. As Congressman Arrington mentioned, small businesses and entrepreneurs are the largest source of net new job creation in the United States, and so they're going to play a pivotal role in getting us back to growth. Those two areas I'm going to focus on are reforming and continuing to build on the net operating loss deduction changes that were originally made in the CARES Act that ensure that businesses have adequate liquidity, as well as mentioning some ideas to streamline the tax treatment for new economy and gig workers who have been absolutely vital in having all of us make it through this crisis in a socially distanced way. So to start with the first idea as it relates to net operating losses, the CARES Act, which was passed in March, provided economic relief to businesses in part by modifying the net operating loss or NOL deduction rules, as well as expanding those NOL carrybacks and increasing the limits as it relates to NOL deductibility. Net operating loss deductions are built into the tax code so that firms are taxed on average profitability over time. And we ensure that they're not penalized for having either volatile income or uneven earnings over different tax years. Losses aren't treated like profits in the tax code. When firms earn income, that income is taxed immediately. But when firms suffer losses, they must carry those losses into the future years to offset that future income. Tax provisions like net operating loss carrybacks, which are reintroduced in the CARES Act, let firms apply losses to taxable income in previous years, which provides immediate liquidity to firms and serves as an important countercyclical tool in recessions. Policymakers can take additional steps to build on these changes to ensure that businesses can maintain their liquidity and survive the crisis. And one idea is to allow firms to cash out the NOLs they have on their books already. Why do this? Many firms, such as startups or entrepreneurs who may have created new businesses just prior to the pandemic, may have accrued losses, likely have accrued losses in the immediate term, but don't have that taxable income from previous years to take those book losses and convert them into cash. Accelerating those losses would help those types of firms the most. And as I just mentioned, that's really important because they would be the drivers of net new jobs to ensure a robust recovery coming out of the crisis. From a government revenue perspective, accelerating those assets like losses or other tax assets is mostly a timing change. But for firms, it's a major lifeline that could convert a tax asset already on hand in their books into cash. There are several design considerations when thinking about approaching a policy like this, and there should be guardrails that can be created to ensure that any accelerated NOLs are properly targeted towards small businesses. And another important consideration is that the process for claiming them needs to be simple. As we've seen with some of the experience with carrybacks in the CARES Act, there may be some confusion or complexity as it relates to redeeming those carrybacks or those losses. And that's especially important if we want to target that policy towards small businesses who have accrued losses over the pandemic. The second area I want to mention very briefly relates to individual essential workers working in the new economy. These workers have been some of the hardest hit in this crisis. And they have been invaluable in ensuring that people can receive essential delivery services and other services in a more socially distanced way. Tax compliance was already a pretty major challenge for new economy and gig economy workers prior to that pandemic. And in the wake of the pandemic, these workers are now facing an upcoming tax filing and payment deadline federally on July 15th. and a subsequent series of quarterly estimated tax payments for this tax year. Many of these workers may have struggled to obtain the unemployment compensation that they were given through the CARES Act, and that's because of overloaded state UI systems who have not been adequately changed to accommodate them, or just the broader delays we've seen on redeeming unemployment compensation. And so many of these workers may have been relying on cash flow that was previously dedicated to tax payments to make ends meet. And so this is an important thing for policymakers to consider in the short run, as well as some long-term changes I'm going to mention in a little bit. In the short run, policymakers should consider further changes to the tax filing deadlines to ensure that new economy workers can maintain cash flow and not run into an impending wall of deadlines, which is something, a broader concern that all individual taxpayers are going to have to deal with in the coming months. Staggering those deadlines might make sense, in addition to maybe separating out the payment deadlines from the filing deadlines for gig economy workers. There's also an opportunity for policymaking in the long run to revisit how gig economy and new economy workers deal with the variety of complexities they deal with in the tax code that really is magnified in times of crisis when they don't have that extra cash. And that relates to simplifying how they track and deduct their expenses. There have been proposals, for example, to simplify the expense process for new economy workers, modeled after either the home office deduction or the vehicle miles travel deduction to provide some simplicity there. Gig economy platforms also play an important role here in tax compliance, in addition to the labor law side of things. You can permit them to voluntarily withhold income and self-employment tax, which is something many platforms are interested in, but currently are not able to do, withholding on behalf of their workers, as well as providing tax guidance where appropriate under a safe harbor provision of existing labor law. And there have been previous proposals pre-pandemic that could be changed, strengthened, and accommodated to workers coming out of this crisis. The next few months are going to be absolutely crucial in setting the stage for a more robust recovery, both from the public health perspective and from an economic activity perspective. And it's going to be important for policymakers to balance the need for further short-run relief with an eye toward the longer-run growth perspective, so that Americans can get back to their pre-pandemic lives safely and rapidly. And smart tax policy is going to play a big role in whether this effort works or whether we end up stumbling along the way. And my fellow panelists, Ben and Carl, are going to provide additional ideas that could increase growth through tax policy.
Well, thank you very much, Garrett. That's really interesting ideas there. I want to follow up with those in the Q&A section, because I think that's some of those issues have not been addressed in the larger public debate, and it'd be good to return to that. Now we'll turn it over to Ben. And I know, Ben, you and your colleagues at the Progressive Policy Institute have been spending a lot of time thinking about post-COVID policy changes. If you could walk us through some of the issues that you've been fleshing out, and give us your perspective on what would be most effective in the post-COVID recovery.
Sure, Scott, and thanks for inviting me to participate in this panel. I'm going to start by keying off what you and the Congressman talked about regarding the big debt that we are accumulating during this crisis. As the Congressman said, I think accurately, we have to do a lot of this spending now. It is absolutely essential to support the economy, but we are going to be coming out of this crisis with the biggest debt burden that we have had in our country's history. And it's not going to be years or decades away from now. We are looking at having a debt to GDP ratio higher than we had at the end of World War II. That was the all-time record. We're going to reach that within the next year or two. To give some more numbers about just how big of a hole we're digging, we're looking at a deficit this year that's going to be about somewhere between $4 and $5 trillion, probably $2 trillion next year, and then well over $1 trillion every year after that. And we can borrow now in the immediate crisis, but one of the important things that we did after World War II was we were able to, after the emergency passed, we were able to start paying down that debt and reducing our debt burden. That's not the situation we're facing today. The debt is going to keep growing if we keep our current policies in place, even after the crisis is averted, passed. And so we need to start thinking now about the policies that are going to position us for long-term sustainability. He mentioned the spending challenges that we're going to have to deal with. And certainly with an aging population, the crisis is likely to exacerbate some of the trends that we've seen with Social Security and Medicare spending growing dramatically. We're probably going to see the Medicare trust fund running insolvent, the Part A trust fund running insolvent around maybe before the 2024 election, and Social Security could be facing financial challenges around 2028 or in that general range. And so when we have this debt crisis, we can't, the congressman's right, we can't spend our way out of it, but we also can't tax cut our way out of that either. And a lot of the recently passed tax cuts, I think, make dealing with that challenge worse, especially when we have neither party really particularly willing to talk about some of the specific policy changes that we would be needing on that front. And so being the panel's progressive, I'll be the bad cop who will talk about some of the ways that I think we need to seriously look about raising revenue in the near future. I think it's important that ultimately we have to realize that everyone is going to have to chip in. We've had a trend in recent years where Republicans cut taxes for everyone, and then Democrats take over and they reverse the tax cuts for the rich. And then Republicans take over and they cut taxes for everyone again, and Democrats reverse the tax cuts on the rich. And we do that back and forth and back and forth. And that's brought our revenue levels to historically low levels as a percent of GDP. Contrary to what the congressman said, after the tax cut bill passed, that brought our revenue as a percent of GDP down to the lowest level it had been during an economic expansion in decades. And that's just not sustainable with an aging population. And so while we need to look at the spending side, we also need to look at how we're going to be able to pay for these programs. So what do I think the goals of what future tax reform should look like? I think we want a tax code that is efficient, that raises revenue as efficiently as possible with minimal economic distortions, and we want it to be progressive and fair. And so what I think that looks like is for the middle class and lower income people, I think we need to start thinking more about taxes on consumption that are broad-based, that don't produce economic distortions, that are difficult to avoid. I also think these can function as a good automatic stabilizer, and they also have the benefit of being generationally neutral. One of the big challenges we have with the debate around tax and entitlement reform is how much of the burden should be borne by retirees versus workers, and that's a generational question. And I think that one of the benefits of consumption taxes is they're generationally neutral, and they spread that burden around more fairly. I think we also, as one of you mentioned earlier, we should be looking at a carbon tax, taxing externalities that otherwise do harm to our economy. I think that we should be looking at ways to improve incentives in the tax code for work and subsidizing work for lower income people. So things like expanding the EITC, I think would be really good for economic growth. I think that we need to be looking at making some changes around the tax reform bill from 2017, building on what works and scaling back on some of the things that don't. So for example, I think the 199A deduction was very expensive and probably not going to do very much for growth. We want to scale that back. We'd want to probably need to raise the corporate tax rate. We cut it down to 21%, and while I think everybody agrees that our rate was too high and uncompetitive before the crisis, I think the reality is we cut it way more than we paid for by getting rid of deductions, and that's going to need to come back up. So we proposed bringing it back up to around 28%. I think that's roughly the level we need to bring it to. I think that around full expensing, I think the congressman is right about that as a long-term goal. I think that would be beneficial, but we also should be looking at scaling back some of those, some other tax preferences and deductions that I think don't make a lot of sense to do in a full expensing environment. So for example, curtailing the deductibility of interest, I think, is an important way to make sure that we're not subsidizing the same thing twice and are having a more efficient tax code that raises an appropriate amount of revenue. And then I think we also need to look at other ways to close loopholes in our tax code. and various credits and deductions that are costing us revenue. So, for example, the SALT cap, I know that a lot of Democrats and people from high tax states want to repeal it. I think there are certainly some issues with it, like the marriage penalty that need to be resolved. But we don't want that sort of thing to be repealed and make even bigger holes in our tax code. And the SALT cap is actually going to expire in the next several years if no action is taken. And so I think we need to be looking at making permanent some of the tax changes that actually raise revenue, reforming some of the ones that aren't quite meeting our goals. And then we need to look at making sure that we are raising revenue from everyone in a way that is both efficient and progressive.
Well, thanks, Matt. Oh, that was very interesting. And I'm looking forward to coming back to the issue of consumption taxes and generational equity. That I know there's been a lot of debate about that, and I found your comments really interesting. And certainly, I think we'd have some agreement on quite a few things like SALT 199A and certainly expensing. So I think we've got a lot of room for discussion here and potential collaboration. We'll now move over to Carl, and he'll wrap us up before the Q&A section. Carl's team has been doing a lot of modeling of various tax and reform proposals with in mind the recovery period. So Carl, I'll turn it over to you to wrap up the panel. Waiting for Carl.
All right, thanks, Scott. So Garrett talked a lot about expanding liquidity, which I think is really crucial in the period we're in right now. But Congressman Arrington and Ben, I think, were right that dealing with the sort of long-term challenge of debt and the deficit are going to be major issues going forward. What I want to talk about is sort of expanding growth in the new normal. And that's going to be crucial because when we think about the debt to GDP ratio, an important part of that is GDP. And it's an important part both because as we expand the economy, the debt to GDP ratio goes down mechanically as GDP gets larger, but also because revenues go up as GDP gets larger. And so there's really no way that we can bring down the debt to GDP ratio without bringing up GDP. Right now, coming out of this crisis, we face challenges that are both structural and cyclical. When I talk about structural challenges, I mean fundamental changes to the way the economy works because of COVID, because of the new environment that we're in. When I say cyclical challenges, I mean essentially the challenges associated with high unemployment and the way high unemployment, perpetuates joblessness, low GDP, and an economy that's operating under capacity. So the structural challenge here, I think there are two big parts. One, we need people to feel safe coming back to work. We need people to feel safe visiting stores. We need people to feel safe going back to restaurants. We need people to have an environment in which they can go as close to normal as we can. We don't know when we're going to get a vaccine. We don't know when this entire crisis will be over, but we do need to get back to normal as soon as possible in order to grow GDP and help us get out of this situation. The second thing is looking at reshoring or restructuring supply chains. So the world has become a lot more complicated. We can't depend on some of the suppliers that we had before. We don't know how COVID is going to affect other countries. We have increasing tensions with some other countries. And there are lots of reasons why we might want to change our supply chain. And in particular, employers might want to bring some production back to the United States, right? And so when we think about doing that, right, both of these concerns together create an enormous amount of uncertainty about what's going to happen. Garrett mentioned that we might have the possibility of a V-shaped recovery. What that would mean is that essentially, as soon as we lift the lockdowns and as soon as the sort of infection rate goes down, maybe over the summer, maybe as a result of changes in the weather, that the economy just goes back to normal and people come off unemployment, go right back to their jobs, restaurants open back up. that would be our dream scenario. But we don't know that that's going to happen. The worst case scenario would be something like an L-shaped recovery that's similar to what we had right after the Great Recession. That would be where, we stop falling, but we don't actually start, catching up to where we were. We just start growing slowly at this sort of bottom rate, and it takes us years, maybe decades, to work out the unemployment that we built up. I think Garrett mentioned that we might get to 16%. I think we could possibly be higher than that. But even at 16%, that would be one of the highest unemployment rates since the Great Depression. I think maybe actually the highest unemployment rate since the Great Depression. It could take decades to work that out. And so what we need to think about is what can we do to move us more in the direction of the V, even if we can't guarantee the V. And I don't think there is any way to guarantee the V without knowing what's going to happen to public health, what's going to happen to the virus going forward. But if we can move us more in that direction, the greater chance we have to get GDP back to normal, get the economy back to normal, get revenues back to normal, and that will help solve a lot of the debt to GDP ratio problem that we're seeing. So as Congressman Arrington mentioned, and actually has been mentioned as well, one of the most powerful tools that we have to do that is full expensing. Full expensing does a couple of things. It lowers the cost of capital. It encourages long-term investments. And right now, one of the things it does is it creates a boost to the economy that's similar to what the Federal Reserve would normally do during a recession. The Federal Reserve normally lowers interest rates to encourage investment during a recession. That sort of kickstarts the economy and causes it to grow. The Federal Reserve can't do that right now because interest rates, or the interest rate that it controls, is at zero. It can't lower it below zero, and so it has limited capacity to help us. But full expensing can provide a similar sort of boost to investment that can restart that economy. And so specifically, what we've said is that we should repeal the R&D amortization that's going to go into effect in 2022. We should make permanent full expensing of equipment and machinery that came in TCJA. That was temporary under TCJA, but we think we should make that permanent to give businesses, long-term certainty, to allow them to start engaging in the kind of investments they need to do now, even if they're going to take multiple years. They'll know that they'll get that expensing. And perhaps most powerfully, we think that we should expand full expensing to structures through a process that we call capital cost indexing. It's also called neutral cost recovery. How this would work is that normally companies have to depreciate or amortize investments over time. Because they do that, that decreases the value of that depreciation. That makes effectively the cost of the investments higher than they otherwise would be, and therefore just lowers the amount of investment that is economical to make at any time. Full expensing solves that problem by allowing companies to take all of their deduction in year one. For capital structures, for structures, full expensing could be a little bit disruptive. The cost of structures for buildings, especially very large buildings, can be extreme. That can create an enormous deduction right at once, a huge NOL. That can be hard for a company to manage. It can also encourage what we might call tax harvesting, which would be hedge funds who come in and try to invest in buildings, not so much for the economics of building the building, but because they happen to have really high profits in the year, which they want to offset with a very large deduction, so they invest in the building. So what we suggest instead of doing full expensing for structures is that we index the depreciation that companies take every year at a rate that's something like 3% plus inflation. What that does is that maintains the economic value of the depreciation over time and gives companies the same incentive to invest in structures that they would have under full expensing. That's going to be really important, especially for some of the reshoring efforts, because what we're expecting to see is some manufacturing to come back to the United States. That's going to mean the expansion of new factories. It's going to mean the expansion of new warehouses, of new facilities that are necessary to produce a supply chain inside the United States. We might also see sort of a lot of the infrastructure that we have in the United States alter to become sort of more COVID compliant or more pandemic resistant. We might need restaurants to expand in size or have more seating, other adjustments to structures that would make them durable over the long term. Like I said, I mean, hopefully this will all be over soon, but we don't know. We don't know when it'll be over. And so providing providing companies with the tools to make adjustments that will make them resilient to that provides a big boost to growth. So that's the number one thing that we would do. We think that, you know, doing that now provides, like I said, the certainty going forward, provides the planning going forward. When economists look at how businesses make decisions, they're not just year to year. They're not just thinking about how many deductions do I get today. They're making long-term plans over 5 years or more, and they need the certainty that comes with knowing that no matter how long this project lasts, no matter what the uncertainty is associated with the virus, that they'll have the expensing in place to make large investments, we hope large investments, to sort of rebuild the American infrastructure, to make it resilient to the virus or whatever else we'll see, and to sort of jumpstart the economy and get it going back, get us as close to a V as possible. There are a couple of other things that I think we should do. One of the things in the CARES Act that Congress did was it passed a boost to unemployment insurance. Congress gave an extra $600 a week boost to unemployment insurance. That was designed to make workers whole who were laid off by no fault of their own. The virus came through, we had lockdowns, people were forced to go away from their jobs, and Congress wanted to do something to make them whole. As Garrett mentioned, the unemployment insurance systems in states were antiquated, and so simply saying that we're going to pay you what you were making at your job before wasn't technically feasible. And so Congress just added a $600 bonus to everyone that would hope to make most people whole. But it created a situation where some people now are making more on unemployment than they would be at their old job. And this does do something to help mitigate the income loss associated with the crisis, but also it makes it difficult for employers to restart because they'd have to attempt to hire workers who are making more on unemployment than they would be at their job. And there's an incentive problem there, and there's also a moral problem there of calling workers back in the midst of a crisis to earn less money at the job. And so one solution that that may be available that we've talked about is allowing workers to sort of cash out their remaining UI. So if you come back to your job earlier, you would have been eligible for UI for a number of remaining weeks, but instead of getting that paid out over a number of weeks, you get a portion of it paid out to you immediately as you come back to your job. That'll help cushion the economy as well as giving workers incentive to get back to work. The other thing that we want to think about when we're talking about how to create the V is, what do we do about states? And so, like the Congressman mentioned, states have balanced budget requirements, balanced budget amendments that they've passed. That keeps them fiscally responsible, but it also means that right now when revenues are going down, they have to take drastic action. Some of that drastic action could be sharply higher taxes that would slow growth. That's exactly what we don't want. Some of them could be imprudent layoffs that might even include first responders who we still need as this crisis rolls off. And so we need some sort of aid to the states, but we want that aid to be responsible and sort of appropriate to the crisis. And so state and locals have about 1.6 trillion in what we call own source revenue. That's basically taxes. So far, Congress has provided about $457 billion in direct aid. It's provided about $500 billion in loans, so about $1 trillion in aid to the states. There have been some proposals to provide another $1 trillion. That would almost certainly be excessive because it would exceed the own source revenue that states already have. So, you know, even if this crisis were to totally knock out state and local revenue and there were expenses on top of that, adding another $1 trillion would probably be excessive, would encourage states to spend that money on things that are not related to the crisis. That's not because they're necessarily bad actors, but governors looking at taking care of their constituents are obviously going to look to get as much as they can from the federal government. If they don't do that, other governors will, and so they have to act. So we think Congress probably needs to be a little bit more responsible about how it aids the states. One of the things that we've thought about is possibly increasing the Medicaid match. And so federal and state governments share the cost of Medicaid, especially now when health care crises are higher. What the federal government could do is increase the portion of Medicaid that it makes up. That would provide relief for the states. If that's not enough, and we should judge this going forward by how much revenue we actually see the states losing. If that's not enough, then we might provide another small round of assistance, $100 billion, maybe a little bit more, based on population of the state. That would allow states to have a little bit more of a cushion, but it wouldn't give them the sort of incentive to engage in excess projects or things unrelated to the crisis. And so those are the three things that I think that we can do to help us get back to the V, to help us spur growth as fast as possible. And the sooner we do that, the sooner we raise revenues, number one, but also just because we're increasing GDP, we lower the threat of the debt to GDP ratio, and that makes the economy more stable going forward.
Thank you very much, Carl. And thanks to all the panelists. Boy, I'm sifting through quite a few questions here. And what I'll try to do is package some of the very similar questions that we have on various topics. And one of the topics that we are getting some questions are about small businesses in particular. And I think there's a lot of concern about that. Needless to say, as we all see the restaurants and dry cleaners and other small businesses that have been suffering. And one of the questions I had, we got, and maybe this is for Garrett, is about some of the options available for small businesses, in particular, weighing something like, would cutting capital gains taxes, for instance, be an appropriate thing for small businesses relative to some of the other proposals that you might have mentioned? And then maybe a follow-up, if I could, Garrett, if you could talk a little bit more about some of the ways in which the various platforms can help gig workers and how we might allow them to, you were pointing out, withholding on behalf of gig workers is an interesting proposal that they're not allowed to do now. How might we change that to make that a more efficient process?
For sure. Yeah, to address the first question, the one maybe a good problem to have or challenge coming out of the CARES Act is there are so many provisions for small business owners to take advantage of that they may not know, may not be aware about, or may not understand all of the intersecting rules and implications as it relates to taking one relief option over the other. We've seen this most commonly, of course, with small businesses that might be taking the Paycheck Protection Program, and then whether or not that may disqualify them from taking the employee retention credit, which would provide a credit for employees that have been that are not working but remain on payroll, or whether that might prevent them from deferring payroll tax, right? And all of these overlapping programs serve as options to let businesses survive the crisis and provide needed liquidity, though there are some, as I just mentioned, guardrails and rules as it relates to picking one or the other. So it's really important not just to familiarize yourself with all the options, but also what the implications of taking one option are versus the others, at least in terms of short run liquidity. That's really important as we continue to see what the take-up rates are for the various programs. And complexity, of course, is another overriding concern. Related concerns with the PPP as it relates to access to the qualified banks or creditors who might provide those loans, whether or not small business owners are properly in the queue or not, or are getting access. And so those are relevant policy questions that I think will be revisited in phase 4 to ensure that small businesses do have access to those various programs. When it comes to the capital gains idea, this is something that we've heard floated a little bit by various folks in the policy community. While it's an interesting one, and well-intentioned, it may not be the best tool to spur growth right now. What we need to be looking at and targeting is reducing the tax burden on business investment from a long-run growth perspective. And so the types of policies or changes that Carl had mentioned in his presentation and Ben will be better targeted to ensure that investment happens. And the economic evidence, it's questionable whether or not the capital gains tax cut actually would provide that, though it is well-intentioned that we want to reduce, going toward that direction of reducing tax burdens on those who are trying to invest in the US and firms who are up and running. When it comes to the gig economy side of things, it's an interesting intersection of the tax code and labor law. So under current labor law, gig economy workers are considered independent contractors. And so what that means is gig economy platforms have to follow pretty strict rules on how much they can guide their workers. There's of course a big controversy about whether or not certain types of gig economy workers are misclassified or not properly classified as employees or independent contractors in various states. But the one big implication of this from the tax side is they are very limited in giving out either tax advice or pointing folks to credible tax advice, and they cannot withhold on the behalf of those workers because that would be an activity closer to what an employer would do. And so it risks the current arrangement in terms of work classification if they went ahead and did that. There are various proposals, for example, Senator Thune's New Gig Act, which was reintroduced this year, which would provide a safe harbor to firms to allow them to sort of separate out in good faith the question of what the proper classification of gig economy workers are, while also allowing them to elect to withhold both income and self-employment tax on behalf of workers. And what we've seen in the data is the folks who are most out of compliance with paying their income and self-employment tax are gig economy workers who generally have to do that all on their own. And so that's one big option to get gig economy platforms involved. We've seen some folks very publicly saying they'd be interested in that if that was an option. And so we're cautiously optimistic this might be something that could get support across the ideological spectrum as a next step forward, regardless of your views on the labor law questions.
Thanks for that. And well, Ben, you came through. Ben promised to stir up some heated debate, and we've had quite a few questions come in about consumption taxes. And the questions are all varied. You know, what role does maybe a digital services tax play? What, you know, does the crisis offer an opportunity to move away from income taxes to consumption taxes? What do we mean by consumption taxes? Does that mean a value-added tax? Does it mean more fundamental tax reform? We have quite a few questions that involve moving completely away from our current system towards something like the fair tax or a flat tax. So there are a lot of interest in just complete and fundamental tax reform. So that's quite an opening. And maybe I'll kick it over to you, Ben, and just, what do you mean by a consumption tax? How might that work? Would it replace something or be an add-on? And then maybe talk about the generational issue, because it's always been my impression that a consumption tax is actually not generationally neutral, because you're taxing the savings of retirees now after, you know, with this new form of tax, because it's essentially consumption. So anyway, let me toss that over to you. There's a lot to work with there, and let us, you know, tell me what you think. I think you're still muted.
Thanks, Scott. Yes, that is quite a lot to work with. So I guess I'll just start by talking about what I kind of see as the right way to incorporate consumption taxes into the tax code, and then I'll try to hit as many of those other questions along the way as possible. But you can feel free to follow up on any that I miss. So I think that the important thing to think about from a consumption tax perspective, well, I'll start with what you asked about the generational equity perspective. And I think it's sort of a question is relative to what? I think that if we're thinking about an alternative way of dealing with some of our budget challenges, whether it's, if we're looking at immediate cuts to Social Security and Medicare, that's not particularly generationally neutral because it's hitting today's seniors particularly hard. But on the flip side, if we're just doing it as a payroll tax increase, that's exclusively hitting younger workers, and those are payroll taxes that today's workers will have to pay, even though generations of retirees, today's retirees, have been paying significantly lower taxes because they didn't adequately fund these programs in their working years. And so when I say a VAT is generationally neutral, it is true that I think it is hitting savings in that way, but I think it's more generationally neutral than any of the other alternatives. I think that if you were to ask seniors, would they prefer a cut to Social Security or would they prefer a consumption tax? My guess is it's probably more popular. And I'm not saying that we can't do a mix of these things, but I think that the consumption tax is probably one of the more fair ways to do it. As far as what I think the appropriate role for the consumption tax is in our tax code, I think we definitely need to look at something like a national value added tax, because it is just a particularly efficient way to raise a lot of money. I think that, and I would recommend people check out PPI's progressive budget for equitable growth that we published last year. It's on our website. And what we propose is essentially to add a national VAT, but at the same time put in a number of other provisions that will help make it more progressive and make more sense within our current tax system. So we actually propose moving away from payroll taxes and towards the national value added tax as a way to expand the revenue base, cut taxes on workers and on work, but also expand the revenue available for these important programs. And then I think that there is still a role to play for taxation of income. One of the questions I see here in the chat is about the progressivity of a consumption tax. Lower income people spend more of their money on consumption. And we certainly don't want that. The goal here is not to raise taxes on the people who can least afford to bear the burden. We want to do the opposite. And so we propose is to offset a lot of that burden in a number of other ways. So expanding the earned income tax credit, doing an upfront rebate that will offset the cost of the VAT for people who are on income support programs and don't have any earned income because they can't make any earned income. There are ways to mitigate, and then of course, like I said, scaling back the payroll tax. So there are ways to make the consumption tax hit people lower on the income spectrum a lot less. And then on the flip side, I think we absolutely need to look at income taxation in various forms and increasing those taxes on higher earners, wealthier individuals, because the only way that you're going to be able to get them to pay their fair share is with taxes on income, even if they're not as efficient as consumption taxes. And so here we propose things like more equitable treatment of capital gains relative to ordinary income. I think one thing we absolutely should look at more is inheritance taxes. I think that we have to raise the money from somewhere, and I would much rather raise the tax on money that you inherit from your parents rather than money you earn through your own labor or through productive investments. And I think that we otherwise need to just look at our income tax brackets and see if they're really fulfilling our revenue needs, because ultimately we have to pay for the government that we want.
Well, I'm glad you addressed the issue that was in the chat there, because I think that was someone who was saying, wait a minute, I thought that progressives didn't like consumption taxes because they hit the poor, but you obviously addressed that in your more expanded budget policy from last year, which is kind of similar to the Michael Gratz approach, if you will, in that, Gratz advocated a value-added tax, and then in basically eliminating income taxes for anyone under $100,000 a year and so forth, and then adding a progressive layer on top. So you've approached it in a slightly different way by lowering payroll taxes, but it's a similar concept and actually very interesting. Be interesting for our team to model something like that, if you like, and see what that does to economic growth. Carl, in a way, your discussion about moving or expanding expensing and so forth is kind of a move toward a more consumption-based tax or a cash flow tax. Perhaps you could expand on that a little bit and what that means for the broader economic growth.
Right. So moving towards full expensing, like Scott said, taxes sort of the cash flow that a company has, rather than a concept of income that's more closely related to balance sheets or what they would report to their shareholders. What we find when we do that is that for a relatively small cost, so for the structures provision, which we think is one of the most powerful provisions. It would actually only cost $83 billion over 10 years. We could increase growth by 2.8%. When we look at our full package, the cost would rise to about $600 billion. Full expensing for equipment, because it's all taken in the first year, is a little bit more expensive up front, although the long run cost does go down, and so that's good for the long run debt to GDP ratio. But that increases GDP by 5%, increases wages by about 4.8%, and by our estimates, produces about 1 million sort of long run jobs. And so that's not just pulling people back into the workforce who've been unemployed now, but after we do that, increasing employment by another 1 million jobs. And the reason it does that is because it makes the investment more economical. That raises productivity. Productivity raises wages, and higher wages pull people back into the workforce. We saw that after TCJA. A lot of people estimated after 2016 that we would see extremely low growth, around 1%, in part because they didn't think the workforce would grow anymore. Unemployment was already low. But what we saw was that when companies had a really high demand for labor, they were able to pull people who were otherwise out of the workforce back into the workforce, increase the overall size of the economy, and grow faster than expected. And so one of the benefits from TCJA is that we didn't have the sort of like 1% growth that we thought we would have. We had much higher, around 3% growth after it was passed at the peak. We can continue those high levels of growth if we move to something that's closer to a cash flow tax that doesn't bias the system against investment.
Thanks. We have I guess maybe a more political question, and we can begin to wrap up with this one. I guess this is on sort of the long term, and do you see any substantial changes to the U.S. tax law after the election? Of course, we have a 50-50, you can go either way on that one, I guess. But actually, maybe bring that into the current too, because people are talking about a round 4, phase 4 package. What do you might see in that versus what might be the policies next year and beyond? And maybe we can start with Garrett and just kind of work across our panelists to talk about that. And it brings in a little bit of politics, but also just the sequencing of what we might see first in phase 4 versus what we might see in the future. Garrett, you want to take that one on?
For sure. Yeah, on phase 4, there are some areas I think that across the board folks see opportunity in building on from the CARES Act. The first, which has still been subject to discussion about design and amount, is any federal relief to states and localities. Of course, there's a discussion about how that should be designed and what incentives we're creating at the federal level and how much relief needs to be provided. But there does seem to be a growing understanding that something should be done there. The timing and amount, of course, will vary. And of course, we've argued in favor of using some sort of either a population-based metric that's very broad-based or an in-kind support to states and localities, regardless of the level of support that may end up happening. So something may end up happening there, especially if we're starting to see more layoffs at the state and local level. Additionally, there has been growing interest in revisiting some of the programs in the CARES Act, especially as we're starting to see those looming expiration dates for the Paycheck Protection Program that ends in June. So we may see either reforms to the Paycheck Protection Program, maybe expanding the amount of time that firms can use the money before it is forgiven, relieving some of the limitations as it relates to using PPP funds for payroll, resolving some of the taxability questions as it relates to loan forgiveness, as well as maybe bolstering the employee retention tax credit, which is something that was thought of in the HEROES Act that the Democrats had proposed a couple of weeks ago, that some Republicans have also expressed some interest in, that might have some bipartisan interest. The other thing that Carl had mentioned, of course, is at the end of July, the unemployment insurance provisions in the CARES Act end up expiring for the additional $600 for the pandemic unemployment assistance. And so that will be something else that policymakers, just based on the timeline, will have to come back and see what makes sense there, either in the form of just a raw extension, a reduced amount from 600 to something lower, or pairing it with some sort of rehiring bonus, which is another alternative option here. Beyond that, it's less clear because both parties have such different visions for phase 4, which is a little different from what happened in the CARES Act, where we see very different approaches, as you can see by comparing the HEROES Act to some of the proposals that the administration has publicly announced. And so that's some of the things we know are coming down the pike in phase 4, which is still very much thinking in the short run. While next year, depending on how the elections play out, there's more opportunity for longer vision, the differences in the vision there. And I point folks, if you're interested, to look at former Vice President Joe Biden's plan as one that could be followed if the Democrats end up taking control in Washington. And contrast that, of course, with some of the ideas that Representative Arrington had just aired earlier today about the alternative vision that folks have for longer term tax policy.
Thank you very much. And Ben, what do you see things going?
So I guess I'll probably talk a little bit more about what I sort of see happening based on the Biden plan, because that's probably the list of options that I'm most familiar with. I think that we've seen in his tax plan, the focus has mainly been on reversing a lot of the tax cuts at the higher end from the 2017 tax bill. So, for example, restoring the top individual income tax rate, I think, is something that would have very broad support if Democrats have control. I think raising the corporate tax rate up to some level, I think there is a disagreement about what level. I've seen anywhere between 25% and 35%. Biden himself has proposed 28%, which is similar to, which was the same one we did. So I think, especially if we continue to see this discrepancy of the stock market going up while we have everybody unemployed, I think there is this strong desire to see some of the business tax cuts rolled back among a lot of Democrats. And so I would expect to see some increase in the corporate tax rate, albeit not to the previously high levels. I think that we're going to see a lot of attempts to increase taxes on foreign profits. Biden proposed a 21% minimum tax rate on foreign profits, a minimum book tax. And so I think things like that we're likely to see. And then just other tax policy changes designed to go after the incomes of people at the upper end of the distribution. So he's proposed to end the step-up basis, which allows people to inherit a larger share of untaxed capital gains without paying an inheritance or an estate tax. I think that we're likely to see Democrats try to get rid of that. I think we're likely to see an attempt to treat capital gains taxes more similarly to income taxes. I know that Senator Wyden has been working on a mark-to-market proposal. I don't believe Biden's endorsed that, but I know that's something that a lot of Democrats are interested in. So I would expect some discussion about that. And then finally, we're going to have to do something about the 2017 tax bill when it comes up for expiration. This is looking a little further down the line, but I would expect there has to be some change to the SALT cap if it's going to be made permanent, just because of all the consternation it's caused among so many Democrats representing these higher income areas, and then other changes to some of the provisions in that bill.
Thanks. Carl, what's your crystal ball tell you?
Yeah, so I think it depends a lot on how the election goes. If the Democrats win, I think a lot of what Ben said is going to be on the table, especially the business tax increases. One of the things that we're concerned about is the corporate tax rate increase. I know that there's a lot of debate about that, but one of the things that should be considered is that in TCJA, the base of the corporate tax was expanded. And so even if you were to go up to 28%, that sounds like that's halfway between maybe where we are now at 21% and where we were before at 35%. But since the base is larger, it would actually be a tax that was higher on most corporations than what we had before. So we'd at least be concerned about that. I think if the Republicans win, like Congressman Arrington said, there are a number of proposals out there for tax cuts 2.0. Some are looking at attempting to simplify the number of brackets that are out there. Some are looking at cutting the capital gains tax rate. Some are looking at maybe a special tax rate for companies that reshore. We'd also point the Republicans against some of those plans towards ones that are more focused on moving towards a cash flow system. Obviously, the full expensing stuff that we've endorsed, we could go further towards a cash flow system that would incentivize investment, that would be more powerful for growth. So we'd push Republicans in that direction if Republicans were to win.
Well, thank you. And Garrett, Ben, Carl, thank you for some really smart, thoughtful, and insightful comments. It sounds like we've got at least 2 more programs that or ideas for future programs that came out of this. Certainly the issue of deficit reduction and debt reduction and bipartisan efforts that Congressman Arrington mentioned, and the issue of consumption taxes. I think Ben's raised something that obviously deserves more exploration as people begin to debate that. And hopefully that's something we can revisit, because our team has been modeling some different proposals, and it's certainly something that deserves further discussion. So thanks to all of you for tuning in today to our Talking Tax event. Please check back at the Tax Foundation website, or certainly sign up for our listserv so you can learn of future events that we'll be having over the next couple months. And again, I'm Scott Hodge, President of the Tax Foundation. Thanks for tuning in, and we look forward to seeing you down the road. Thanks again.